what do you do for a living?
Private equity.
What do you do for a living?
Private equity.
Private equity? Nice car. Awesome. Thank you. Private equity?
Brand names that have been destroyed by private equity. What's the sort of overall political landscape right now?
More than 30% in major cities across the U.S. There's a handful of reasons for the surge, but experts say one in particular is key: private equity.
People why private equity is so evil and bad. And second of all, tell us how we could basically bring it to its knees.
You've seen the interviews. You've seen the news articles. Private equity is taking over the world. Private equity is this big mystery, and it seems like everyone in private equity is rich. I'm here to break down why. How does seemingly everyone in private equity earn enough money to afford a Lamborghini? Today, we're going to take a deep dive into the private equity industry, exactly what it is, how the business model operates, and how everyone makes so much money. So in order to know what private equity is, let's flip that term on its head and look at the opposite: public equities. We've all heard of public equities. Stocks like Amazon, Google, Facebook, McDonald's. When you buy a share, you actually own a percentage of these companies. But what people might not know is that there's a whole other side of the market making up approximately $10 trillion globally. These are the private markets, and they represent the shares in companies that only the rich and powerful have access to. Chances are, if you're watching these videos, you can't get access to these investments. Between regulations, closed networking events, and a shroud of secrecy lies these lucrative investments. So how exactly does private equity work? Private equity works exactly like buying, fixing, renting out, and flipping a house, but instead of a house, it's a company. The private equity firm will typically hold the company for 3 to 5 years, and in that time, hope to improve the operations of the company and in turn increase the profitability of the company. This can be done in a few ways. One is raising the prices of the goods and services they offer.
Well, I think you had such a massive sell-off in last year that you're seeing it bounce back. Tax law selling was huge.
Private equity represents about 6.5% of our GDP. And if you just take a step back, you would see globally the way businesses are funded today has really transformed over time.
Companies notoriously raise prices after being acquired by private equity companies, as it's an easy way to boost returns with little to no work. Another easy way to drive value is to reduce costs, and the easiest and most dramatic way to reduce these costs is to fire people. Harvard University and the University of Chicago found that when private equity takes over a company, employment in the private equity-backed companies decreases by over 4% in the first 2 years following the buyout. It's even worse with publicly traded companies, with about a 13% decrease in jobs. So now you have a company with higher prices and reduced costs. Customers lose due to the higher prices, employees lose due to being fired, and the private equity firm wins by having incredible returns. Now that you understand what private equity firms do, let's dive a bit deeper into the business model. The main reason that private equity professionals make so much money is the genius business model. Private equity companies don't buy other companies entirely with cash, but they use a financial trick that most people have been told to actively avoid: debt. You may have heard of the term leveraged buyouts, which means that a company is acquired using leverage, another name for debt. How does this help the private equity company make money? Leverage amplifies returns, so when you win big, and normally if you lose big. But how can private equity firms only have the upside of leverage without the downside? When private equity companies use debt, they start a new shell company with the sole purpose of acquiring the target company. The debt is part of the shell company, so even if the shell company goes bankrupt, it's technically an entirely different company than the private equity firm, so they don't take any of the losses. Private equity firms are notorious for putting way too much debt on companies, which leads to companies defaulting, declaring bankruptcy, and ruining some of the most iconic brands in the world.
I don't want Oh, a fun Toys R Us kid.
On the end of Toys R Us.
Shutting down. The final 200 closed their doors for good on Friday. Shoppers leaving this
just ahead of the holiday rush. As you mentioned, Toys R Us did file for Chapter 11 bankruptcy.
Toys R Us, one of the most recognizable companies of the 21st century, suffered a similar fate after being acquired by one of the largest private equity firms in the world, KKR. Toys R Us was once America's biggest toy store, and KKR acquired the company in 2004 for $6.6 billion, using $5 billion of debt. Utilizing this classic private equity strategy of putting way too much leverage on a company, one employee has a harrowing account of exactly what happened. The company eliminated positions, loading responsibilities onto other workers. Schedules became unpredictable. Companies had to pay more for fewer benefits. And when this employee was fired, she was granted no severance, like the more than 30,000 other employees who are losing their job with the company. The company was loaded with an obscene amount of debt and finally declared bankruptcy in 2017. Meanwhile, KKR, the private equity firm, raked in millions of dollars in advisory fees. It's not just Toys R Us. Plenty of companies throughout the years have been destroyed by private equity companies. Once thriving companies saddled with too much debt and forced into bankruptcy while private equity firms make millions of dollars in fees. The story is all too familiar. Fairway Market, once a popular grocery chain with fresh baked bread, great cheeses, and international foods, suffered a similar fate. This Atlantic article states, spread thin and loaded with debt, Fairway was not well equipped to respond to the challenge of steeper competition. The article had this to say about private equity. This record is not just a product of markets, it's a matter of morality as well. Private equity firms profit as the companies they own tumble into bankruptcy. And while these companies are struggling, private equity firms make money hand over fist. The article continues to shine a light on how private equity screws over these companies. In 2013, Fairway went public. Tucked away in the IPO filing was a paragraph detailing how Sterling, the private equity firm, would be able to use the proceeds to pay itself a dividend of nearly $80 million and an additional $17 million from Fairway's funds. In 2019, Fairway filed for bankruptcy. Art Van Furniture, once a thriving furniture store, was acquired by private equity firm T.H. Lee. Here's what Inequality Org had to say. Almost immediately after it bought the company, T.H. Lee used Art Van's golden name to borrow massive amounts of money and saddle the company with debt. T.H. Lee also sold off Art Van's real estate, then forced Art Van to pay rent on the same property it once owned. One employee recounts, then Art Van stopped doing business with our usual vendors. Instead, cheaper products once sold at outlet location went into our main stores. Sure enough, customers started noticing that quality was falling, even though the prices were rising. Maybe this time, private equity won't destroy this company. Maybe not. Payless Shoe Store, acquired by private equity firm Golden Gate Capital, bankrupt. True Religion Apparel, bought by private equity firm Tower Brook Capital Partners, bankrupt. Gymboree, bought by Bain Capital, bankrupt. Despite these iconic companies being ran into the ground, private equity firms still made hundreds of millions of dollars in fees for managing the business and exiting the business. Now we're going to go into detail on another secret technique that private equity firms don't want you to know. We've outlined what happens in the bad scenarios. Companies go bankrupt, people lose their jobs, and the private equity firm rakes in millions. When companies do bad, private equity wins. When companies do great, private equity wins even more by utilizing this secret tax loophole only the rich and powerful have access to. Because buying, running and flipping a company technically isn't considered labor income and is instead considered investment income, these earnings are taxed at the capital gains rate at a maximum of 20%. Whether they make $100 million or $1 billion, they're still only taxed at 20%. You heard that right. These private equity professionals making millions, if not billions per year, are taxed at a lower rate than someone making $45,000 per year, all due to this exclusive tax loophole. With millions of dollars in fees and salaries with almost no taxes, it's no wonder why they can keep all this money for themselves. Private equity is a business model that saddles companies with debt, destroys some of America's most iconic brands, increases prices, fires employees, and avoids taxes, all to line the pockets of the richest people in the world. So next time you see someone getting out of a Lamborghini on TikTok saying they work in private equity, you'll know exactly what they do and how they do it. And that's exactly what this whole channel is about. I'm a finance insider who has worked on Wall Street for years, and I'm here to reveal some of finance's biggest secrets when it comes to business models, financial markets, and aim to show you the best ways to make money, manage your money, and use all the techniques the rich and powerful don't want you to know. So if you're interested in business and finance, interested in taking control of your finances, making more money, and being smarter with your money, this is the channel for you.